System that just ain't right. Gonna tear it down. Gonna start a fight. Anarchy and numbers is my game. I'm the investor with no shame. Greed and corruption, that's the name of the game they play. It's all a shame. I won't play by their rules. I won't comply. Anarchy's the way. It's time to fly. I burn down the walls and break the chains.
And here we go. Welcome, welcome, welcome. My name is Matt. This is the Anarchist Investor Live, coming at you every Monday through Friday at 12 Eastern, talking about contrarian investment, markets, the economy, how to protect, grow, and keep your money away from dirty banksters out there that are trying to steal it from you. So, that being said, as far as the banner down below, a reminder to sub to the Anarchist Investor newsletter. You get a free newsletter every Monday through Friday in your inbox, as well as you're eligible for monthly drawings. Yesterday, I gave away $200 worth of Bitcoin. And so you got to be subscribed in order to be in on that. And last month, I gave away basically $100 worth of silver, as well as some free books and stuff like that. So you got to be subscribed, obviously, to be in on the fun. So today we are looking at, and I had on the hold screen, the 2-year yield, U.S. Treasury yield. Yesterday was one of those swell Federal Reserve Bank decision days that we always get, and I'm sure the economy will improve immediately as a result of it. I feel like I'm channeling my inner George Carlin. So the story and the headline yesterday, and let me pull down the graph, and I'm going to put up the news story out of CNBC here, is Fed keeps rates steady as it notes lack of further progress on inflation. So again, we have to dig into this because not all that meets the eye is actually truthful here. So yes, the Federal Reserve did not change its target interest rate. Something that is becoming more and more and more apparent as time goes on is that the Federal Reserve's interest rate actually matters very little. It's more of a psychological signal to the market than anything else. It's not necessarily anything that has to do mechanically within the market. Now, that being said, there are some things that the Federal Reserve does do that directly interacts with the marketplace, with the financial marketplace, and has some impact. So they didn't change the federal fund rate, but in my humble anarchist investor opinion, the Federal Reserve changed course and they began easing yesterday. All right. And I'm going to build the case for this by scrolling down to the one thing that they actually did change. Now, everyone wants to talk about the statement language and whether or not they said they made substantial, progress in terms of reining in inflation, or whether or not it's stalled, or they said something about the balance between the risks between inflation and deflation have become more in balance. Okay, that is a little bit of a tell, because they're basically telling you that the risk of inflation getting away from them is subsiding and the risk on the side of deflation is growing. I would actually argue that they should have made that statement maybe like 3-4 months ago. But that's basically what people are trying to parse here. What's funny is they're missing some homage is paid to it, but they're missing the biggest thing that actually changed. Like, there was an actual change in Fed policy. And what is it? It's the runoff rate of U.S. Treasuries. Now, not mortgage-backed securities, but U.S. Treasuries from the Federal Reserve's balance sheet is changing. And quoting this article from CNBC, it says, under the new plan, the Fed will reduce the monthly cap on treasuries to $25 billion from $60 billion, meaning every single month it used to be that they would up to $60 billion they would allow to run off of the balance sheet, meaning those treasuries would mature and then they wouldn't replace them. All right. Now that number is dropping considerably to 25 billion per month. And so if I read on further here, it says that would put the annual reduction in holdings, okay, and we're going to kind of flip this on itself, at 300 billion as compared with 720 billion from when the program began in June of 2022. The potential mortgage roll-off would be unchanged at 25 billion a month, a level that has only been hit on rare occasions. So meaning the mortgage-backed securities, they're going to continue to allow to mature, roll off their balance sheet. Mind you, these are in many cases garbage investments that have been essentially the losses have been subsidized by the US taxpayer for the last, let's see, going on 16 years since the Great Financial Crisis #1. That amount of mortgage-backed securities will continue to mature and not get replaced. And what they've basically been saying is that they could do up to 25 billion, but just based off of the maturities on those securities, they're almost never hitting the 25 billion. So it's still kind of like this slow bleed off of these mortgage-backed securities, which, as you could imagine, if they're filled with mortgages, the maturity on these things could be 10, 20, 30 years if you bought them like day one, right? And if they're filled with 30-year fixed, which we know they're not. But so anyway, the bleed off on that's going to stay the same. But the change in how many US treasuries they're going to allow to mature and not replace is dropping dramatically. And so why does that matter? It matters because when the Federal Reserve allows these things to mature, basically what happens is the US Treasury has to send the Federal Reserve cash. And then in the past, the Federal Reserve was taking a bunch of that cash, reallocating it to other programs that it has, or actually literally handing it right back to the US Treasury, which is freaking funny for the general account. But it was handing back a bunch of money back to the US Treasury. And the problem is that the US Treasury is continuing to have to borrow more and more and more money every single year as the US budget deficit becomes, I say, decoupled from reality. I mean, it's never been within reality, but I mean, it's even more so decoupled from reality now than it ever has been in the past, right? I mean, we're paying $1 trillion in interest alone on the debt every single year now. It's just inconceivable, right? Like I feel like Princess Bride, like that's inconceivable. So the U.S. Treasury sends us cash. Federal Reserve basically just sends the cash back to the U.S. Treasury at the end of the year based off of whether or not the Federal Reserve turned a profit or had a loss. Okay, if it had a loss, it doesn't send any cash back. The U.S. actually has to subsidize the losses of the Federal Reserve Bank. I'll get into that in another time and place. It's basically a ridiculous Ponzi scheme of the utmost proportions. But say the Federal Reserve takes some of that money and rolls it back into new US treasuries. Well, then essentially when they give the money back to the treasury, they're not giving it back for the general fund, they're giving it back to the US treasury that is then issuing more US treasuries and essentially rolling over debt through the Federal Reserve. And this is a fundamental thing that must be understood. The Federal Reserve keeps saying, oh, we have this dual mandate, right? We want to keep prices stable and achieve maximal unemployment or maximum unemployment within the economy, within the labor market. That's actually BS. It's complete BS. The Federal Reserve, since its inception and for the remainder of all time, as long as it exists, will exist for one reason. And that reason is to monetize US federal debt. That's it. The Federal Reserve facilitates the issuance of US treasuries. That's it. That's the main role of the Federal Reserve. They do some other things on the side to try and keep like the economy's wheels on the tracks and keep the train from falling off and going kaboom. All right. But actually, at the heart of it, all of that is done so that the Federal Reserve can continue to monetize US national deficits and debt. Well, if they're going to drop back the amount of treasuries that they allow to mature and they're not replenishing, right? They're actually reducing that, meaning they're going to be buying more treasuries than they would have to replenish that stockpile. They're still replenishing it less than the number of treasuries that are maturing. So their balance sheet will continue to contract slowly or more slowly, slower. But this is a tectonic change in terms of what's been happening over the last 2 years. So over the past 2 years, the Fed has been increasing and maintaining higher interest rates, and then they've been essentially selling off US treasuries and mortgage-backed securities, and it's technically not selling them off. It's technically just allowing them to mature, which requires the borrowers to send cash to the Federal Reserve, which then gets destroyed either in terms of going back to the US government in terms of like a surplus at the end of the year for the Federal Reserve, or it gets destroyed by going into these other programs that have been implemented, like the Bank Term Funding Program and like some of the other bailout programs that have been instituted recently for the regional banks. All right. So it's been a cash destruction machine over the last couple of years. Well, now they basically said, okay, we're going to destroy less cash. And what does that mean they're going to do with the cash? They're going to take that cash that normally would have been destroyed and removed from the system, and they're going to place a bid to buy US treasuries. Okay. They've been buyers of US treasuries every single month. It's just they haven't been buying as much as have been maturing. That will continue, but to a much lesser extent. Effectively, that is an easing of interest rate conditions because it creates more demand for the purchase of US treasuries. So this is why we're looking at the US Treasury 2-year yield. Okay. If you notice, after the Fed rate decision, now in the press today, they're trying to tell you, oh, this is they're trying to tell you, oh, this is a function of, everyone was worried the Fed was actually going to have to raise rates. Okay. I've already debunked that one. Inflation isn't going back up. At worst case scenario, it's going sideways. And in fact, the more you dig into the mechanics of it, I'm going to tell you why the Federal Reserve is making this change. It's not because of inflation due to increase in the monetary base. It's due to weakness in the real estate sector, and it's due to the ever-growing problems the federal government is going to have funding these large deficits. Okay, so the U.S. 2-year yield has dropped ever since the rate decision. All right. It has nothing to do with, we thought they were going to raise. No, that's wrong. I mean, the idea that the Federal Reserve was ever going to raise again in this cycle is completely preposterous. And it's because the nature of the inflation right now is supply demand driven. It has absolutely nothing to do with the money supply. Okay. And again, even that movement in those interest rates are proving to be inconsequential. Okay. It's just a psychological thing. All right. Well, US 2-year yield is down. Why is that? Well, moves inverse to the price of the US 2-year Treasury. So the Federal Reserve didn't cut rates yesterday, but the yield is down as if they had. And the price is higher. Okay. And the reason why the price is higher is because this change to the US Treasury runoff from the Fed's balance sheet gets implemented June 1st. So you have a month to basically front run this change from the Federal Reserve. Okay. Simon over at Uneducated Economist talks about this all the time. It's the credible threat theory. Okay. The Federal Reserve doesn't even really have to make this change. They just have to signal to people that they're thinking about making this change. And then a lot of investors with big money will try and front run that shift. All right. They actually are making this shift, which means a lot of investors are now going to begin buying short-term US treasuries because it's assumed that the federal government will continue to issue short-term treasuries so that they don't get locked into higher rates long term, so that then the Federal Reserve can then buy those treasuries as a buyer of last resort. Something also of note is recently a lot of US Treasury auctions have had long tails. And I can't go into depth as far as like what a tail means on a US Treasury auction, but let me put it this way. And who does a fantastic job of explaining this is Joe Brown over at Heresy Financial. Okay, definitely hit up Joe on YouTube. Heresy Financial, Heresy Financial. And of note, interestingly enough, today is the first day I'm streaming to the new YouTube channel. So if you go on to, you can look in the description below. I have a link to the YouTube channel. Started this in separation from the Ungovernable channel that Jocelyn and I do our live casts on every Sunday night. And we're going to crank up some more content that's more related to that channel too. But definitely head on over to YouTube and give it a thumbs up and a subscribe and hit the notification bell if you prefer to watch on YouTube. I know a number of you watch on Rumble. You can continue watching on Rumble if you like, but if you're more of a YouTube viewer, then you can head over there as well. So the reason why the U.S. two-year is of such significance and the tail of these auctions is of such significance is the interest rates can get away from the Federal Reserve. Like I said, it's their job to monetize U.S. debt. Well, if there's an auction, then all of the big money, the Goldman Sachs's and the retirement fund administrators and the hedge funds, and all these people are basically bidding on this debt that the U.S. is issuing. Well, if the U.S. wants to raise $100 billion and they want to do it at 4.9%, that's essentially what they're looking to achieve. But what happens if only the investors are willing to give you 70 billion at 4.9%? Well, you still need the other 30 billion. You have to fund your operations. So what develops is a tail, meaning you got 70 billion at your preferred rate of 4.9%, but then maybe the next 30 billion you have to borrow at 4.91, 4.92, 4.93. Well, within the recent past, the US Treasury auction tails have been getting worse and worse and worse. And so the Federal Reserve is now stepping in, or at the very least decreasing that downward pressure on price, which again drives up the yield. Okay. And so now they're trying to reverse that course. They're trying to increase their buying demand to drop those rates, or at the very least, soak up that tail at the end of those auctions so that interest rates don't get out of hand, or at least out of what they perceive as their control. Okay. Now, this also has implications for the housing market. And actually, if I shift gears and I look sector by sector here, let's see, what am I pulling up? I am pulling up sector by sector, and we're going to look at real estate. All right. This has been the real estate sector. This is a ETF that follows the real estate sector. And if you've noticed, the real estate sector has been weak. It has not participated in this huge rally to the same extent that the rest of stocks have. Why? It's because interest rates have remained high, mortgage rates are high, commercial real estate is in dire situation. Okay. And so real estate has basically remained weak. It's had some periods where there's been a little bit of optimism, but for the most part, ever since 2021, real estate has just been getting shellacked. Okay. Ultimately, I think real estate is going to be a longer term, strong investment going forward, because it's more of this old world, slow as it goes kind of investment. It's just not the flavor right now of the market, because in the casino, they like return, they like yield, they like all this other stuff. Real estate has been kind of stepping back in terms of whether or not it's able to provide those things that the market wants. Well, the Fed is seeing this, and it is identified that the quote unquote inflation that we're seeing, for the most part, has to do with things that are related to higher interest rates. This is also very important to understand. The higher interest rates are now what is propping up the remnants of the inflation that we have. Okay. But again, the Federal Reserve has to weigh this PR battle. If they signal that they're cutting rates because this other aspect of the market is hurt by higher interest rates and actually causing more price inflation, then they could actually end up alleviating that, but then also spurring on inflation or reigniting it in other areas like commodities, which, by the way, have been headed down because of economic weakness. Oil's down today. We'll look at it in a minute. But so they're trying to save real estate, or at least they're trying to take the edge off the pain in the real estate market. The biggest problem in real estate is people aren't selling. There aren't enough homes that are up for sale. And so, even at higher mortgage rates, there are certain regions and certain portions of the real estate market, namely the most expensive homes, that are in this hyperinflationary state. There's also a part of the mortgage of the real estate market being rents, where not very many new rental units are coming online. And so you have a demand supply mismatch. And that mismatch isn't because there's tons of money flowing around in the system. That mismatch is because the handful of people who can continue to pay up, they continue to pay up. Everyone else suffers. They can't pay up. They have to trade down. They lose their home. They, move from a home to a rental, et cetera, et cetera. There's a freezing of the supply side, and it's because a lot of folks, whether it be within the home and property building and development space, or whether it be in the residential space with people buying, they don't want to buy, and it's not because of the interest rate on the new home is on the house that they're selling isn't going to be soaked up by someone who's willing to buy it. It's they don't want to transition into a new home that has a higher interest rate or higher mortgage rate than they're currently paying. Okay. And so there is a stalemate that's happening as far as the supply side. The Federal Reserve has to alleviate that somehow. Well, mortgage rates typically refer back to the federal Fed funds rate, but also specifically treasury rates, because mortgages are loans. Banks give out those loans, and the banks borrow at the short end of the curve and they lend at the long end. So, what the Federal Reserve is trying to do is they're trying to take the edge off on the short end of the curve. The short end of the curve is the 2 year and the 5 year, which is where banks typically borrow at. And if you notice today, we're starting to see weakness in the yield in the short end of the curve, much more so than the long end. If you look over here on the right side of the screen, you're seeing people are buying 10-year treasuries and 20-year treasuries, but they're not buying them as aggressively as the 2 year. This, interestingly enough, is also beginning to squeeze this inversion that has happened between the 2 year and the 10 year that we've been in for almost 2 years now since the Federal Reserve started hiking rates. That inversion destroys things like property development, because a property developer works on spec. They have to borrow money. It's not all cash on hand. And so when they borrow money, they have to borrow it from a bank. Well, banks have restricted lending because a lot of their lending is not profitable when the yield curve is inverted. Okay. The Federal Reserve is trying to rectify this, and they're playing a balancing act where they're telling you they're not decreasing interest rates, but at the same time, they're actually using, so like they think that this quantitative easing and quantitative tightening cycle is now a new tool that they have, because that's actually a direct, I would call it an interference or intervention, but for them, it's a direct impact on the lending markets. They can actually buy or sell and influence interest rates directly. Before, they couldn't do it directly, it was just a signaling mechanism. And so, for anyone who's familiar with the Fed funds rate, it's basically the rate that they lend banks so that they can fund themselves overnight. But for the most part, most banks, they fund each other, right? Like if one has a surplus and one has a deficit overnight, to make it net out, they trade cash, right? It's only when a bank is at a deficit and they can't find a surplus of cash in the banking system that they go to the Federal Reserve and pay that, what would now be in between 5.25% and 5.5% rate. It almost never happens. In fact, when you see a bank go to the lending window at the Fed, it's typically because it's about to die. Right? Like that's what happens. The other banks won't lend the money. There's too much counterparty risk, right? So that interest rate is symbolic. It hardly ever gets used. And when it gets used, it's because some, banking sector participant is on its last legs and it's about to collapse, or it has been collapsing, right? And they're just trying to facilitate the death of it. In this particular case, the Federal Reserve has found a way to directly intervene within the interest rate structure in the marketplace, and they're doing it now. This is the first time. They tried to do it back in 2016. Okay. And so I actually wrote a Substack article this morning about this very topic as well. I'm actually kind of being redundant today, but this platform gives me a little bit more room to elaborate. Okay. They tried it back in 2016, along with raising interest rates. And the financial system was so weak at that point, still, 8, 10 years out from the great financial crisis, it couldn't stand it. They ended up with all this counterparty risk again, and banks were going to blow up overnight if they continued to do that. All right. Well, COVID, and again, I did an episode on this, like, a tinfoil hat kind of episode. COVID was kind of like the blessing that the Federal Reserve was looking for, because it allowed the federal government basically a gigantic blank check, as well as the Federal Reserve, to just inject tons of cash into the system. But the cash wasn't intended to like generate a ton of business activity. There was stimulus checks that was meant to give like a little point stimulus, not sustained, point stimulus to kind of take the edge off on the economy contracting as a result of the shutdowns, the lockdowns. But what they did do was they were able to generate a ton of cash in one fell swoop that then they could warehouse in different places and then use that cash to buy or sell securities. They also gave themselves, or they gave the corporation, specifically the banks that technically own the Federal Reserve, gave them more of a cushion to be able to deal with this problematic ebb and flow, where they were never going to be able to raise interest rates again without crashing the system. Well, guess what? They bought themselves a little bit of a runway, but you still end up having to pay the piper. They kick the can down the road, but you're still going to have to pay the piper. They're using this as what they consider their newfound toy, where they can essentially influence not just US Treasury rates, but just interest rates in general across the board directly. And they had to buy a ton of this stuff to have enough of a market share, so to speak, to be able to then adjust their balance sheet up and down as needed in order to influence interest rates. They're doing it now. Well, as of June 1st, you'll see the Federal Reserve now flexing their muscle within the market to cut without cutting. Okay, to basically ease financial conditions with respect to U.S. Treasuries, short-term U.S. Treasuries, and that easing, they're hoping, is going to positively impact those areas where, again, quote unquote, inflation, right? And I would just say price increases or inelasticity exists. And the biggest one of those would be real estate. I wrote another article last week that talked about why you're continuing to see quote unquote inflation in financial services like insurance, your home insurance, your auto insurance, right? Your business insurance, all of these insurance prices are going higher. Why is that? Because insurance companies invest in highly rated, highly rated debt securities like corporate bonds, like US Treasuries, like mortgage backed securities. They take all of that money that they pool together to pay claims and they buy those investment vehicles so that they can make a little bit of a VIG. It also helps offset some of your premium costs. But if they bought all those things and the prices dropped and the interest rates went higher, they essentially lost money on that. They need to recoup it. How do they do it? Well, they do it by charging you more premium. All right. That premium either has to come out of your pocket or it has to come back in the form of better pricing on those mortgage-backed securities and those debt securities that they purchased. Well, this is also another avenue for the Federal Reserve to directly interfere or intervene in the markets and give some relief to insurance companies and other financial firms that pool money and invest money in treasuries and those kinds of investments. Make no doubt about it. This is an ease. This is a shift in Federal Reserve policy, and it is not being talked about. All right. So then, what does the future look like headed forward? Well, let's look at our future indicator. This is the high yield bond ETF. Yesterday, we were seeing there was a lot of weakness going on. There was weakness like 2 weeks ago, and then there was a back and forth. Oh, is the Fed going to save us? Or are they not going to save us? Are they going to save us? Or are they not going to save us? Well, guess what? Today, it looks like the big money believes that, at least in the near term, the Federal Reserve has ridden in on its white horse, and it has at least saved the debt assets that are out there circulating, that in other conditions, if conditions stayed exactly the same for a period of time, you could have seen a market crash had the Federal Reserve not changed something. So they had to signal to the market, but they're not just signaling, they're actually actively changing their policy. And it's going under the radar because everyone looks at, what's the rate? What's the rate? Oh, it stayed the same. It stayed the same. You got to stop looking at that. That's not the Fed's new toy. That's not their powerful toy. Their powerful toy now is quantitative tightening, quantitative easing. Funny enough, a lot was said about, let's see, Donald Trump was one of the people that, while he was campaigning, they were saying, oh, well, you could have gone bankrupt and you got all this money from your banking friends. And he basically told you, he was like, well, that's like the tactic. The more you borrow from the bank, the more they have to kind of bend over backward to take care of you, because you're a bigger and bigger and bigger risk on their balance sheet. And if they don't continue to bail you out, then they have to write down the loss eventually, right? If they stop funding you because you go down. Well, same thing is true of the federal government and the Federal Reserve. The Federal Reserve is basically the main monetizer of US Treasuries. And so the more the deficit grows, the more money and acquiescence that the Federal Reserve and the banks that own the Federal Reserve have to throw at the federal government. And they basically say, well, what are you going to do? Stop lending to us? We'll go bankrupt. Then we're both screwed. Right? We're in this system now where the Federal Reserve is now trying to impact the interest rate markets directly. Okay? This is a new era. This is a much grander intervention. And it started back in 2008 because the groundwork for buying these types of securities, it started in 2008, but people forget that, like, the buying of this stuff and the quantitative easing, there wasn't just one round of it. There was like 4 or 5. And so over a period of 10, 15 years, the Fed's balance sheet ballooned from 1 trillion to $9 trillion. Interestingly enough, over that period of time, the US deficit rate went up by almost about that amount of money. There is this shell game that exists between the federal government and the Federal Reserve. And you have to understand it to be able to understand how these markets are being manipulated. Now, am I advocating that you go out and you buy US Treasuries or something? No, I'm not. I don't. Me personally, I don't want my money in this system. But understanding how this system does affect the underlying economy is very important, because I think a lot of you, unless you're in the ultra wealthy category, you're noticing a really shitty economy. It's not working for you. Your pay raises aren't keeping up with the price increases. Okay. You're locked into certain places. You might have wanted to sell your home. You can't, because you would have to take on a higher interest rate somewhere else. Okay. Even if you are selling your home, like I had a buddy just recently, there was lots of bids. He took a bid, went through. I helped him move stuff out of the house, and then the buyer falls through, because a lot of these banks, when they're doing their vetting and things like that, the buyer like okays something, and then maybe something changes before they get to the closing table, right? Well, that buyer fell through. That hasn't been happening a lot. And all of a sudden, it's becoming more prevalent the more you dig into it. The real estate market is in dire condition right now. And what they need is supply. That's always been the issue. Real estate market needs supply. The Fed is trying to take the edge off, and they're trying to help the US government continue to run large deficits. So keep that in mind as you're watching some of this news flow that happens following this Federal Reserve rate decision. All right, let's look really quickly around the markets. I know I've been long-winded, and this is like a huge diatribe. The casino's up because, they're telling you, oh, the Fed said they're not going to cut and they're not going to raise, right? No, don't listen to them. The Fed eased. That's why things are up. Elsewhere in the marketplace, let's look. The dollar's down slightly. Again, easing of conditions, right? If the Federal Reserve was really sticking to their guns, the dollar would continue to be strong. Now, that being said, we're not out of the woods yet. This still looks like a bull flag just because the dollar's down a little bit. We'll see what happens with the economic numbers, but typically after the first time the Fed cuts, okay, and I think that terminology needs to be changed. After the first time the Fed eases, usually the worst loss is happening in the casino. It's also when the most economic damage happens because the Fed's almost always late. Okay? You might see some euphoria here. You might see some dip buyers come into the market. You might see some strength in the casino. Do not be fooled. Do not get suckered in. Okay? This will be a weak rally if it does result in a rally. All right? It could just roll over and begin to fall apart because the smart people are doing the math and are like, holy shit, the Fed's easing. There's got to be a reason. And it's because the economic numbers, they can shift like that. That's the other thing that people aren't giving enough credit here to. Inflation on the headline has been moving somewhat sideways over the last 4 or 5 months. Okay? It's taken a while for those prices to come back down from up 9, 10, whatever inflation reading or mechanism you want to use to figure out what the inflation rate was back in 2021 and 22. That number has come down, but it's taken time. Like every month, it's a little bit, a little bit, a little bit. People forget that leading into the great financial crisis in 07, okay, inflation numbers like 1 month were like 2.5%, 2.7%, and then they just fell off a freaking cliff because the economy eventually gave up. And in 1 or 2 months, lots of business can stop being done, which causes prices to drop dramatically like that. Okay? And everyone's like, oh, well, the Fed might have to raise interest rates or whatever. They don't understand that inflation could like moderate and then, especially if there's a major, a major catastrophe or market event. Or, I mean, we've already had one bank blow up this year in Philadelphia. We'll see what happens. I bet there's more. So somewhere there's a bank that no one's thinking about having problems, and it's about to have problems, right? Like that's typically the way this stuff works. What else? Oil's like slightly down to flat. Okay, it got shellacked yesterday. All right, and again, this could be economic weakness right here. People think, oh, this is disinflation and all this other stuff. This could be deflation, right? This rise to 86, I think a lot of people were expecting like, again, I don't think people truly appreciate how weak the consumer is. This rise to 86 in the past could have been the equivalent of a rise to $120 a barrel. The consumer is in a much worse condition than they were, before the great financial crisis. They've spent down a lot of their savings. They're in much more debt. This rise to $86 in oil could have been the straw that broke the camel's back. And oil is decreasing now because economic activity is decreasing. Demand is decreasing. Okay? And this Fed move could be the first in several easings that have to take place because the economy is broken. In which case you could see unemployment rise dramatically in the next couple of months, and you could also see inflation drop dramatically in the next couple of months. Oil's flattish to down slightly today, but it continues its move lower. So something to keep in mind. What also typically happens is you see the market up, okay? And people look at the Wall Street Journal, they'll pull up Yahoo Finance, they'll be like, oh, the market was up. Things must be doing better, right? Like, there must be more optimism in the marketplace. But then there are these underlying indicators that a lot of times they don't pay attention to. Oil is one of those indicators. When oil crashes, it's typically not a good thing. And typically before these large financial events, these large recessions and depressions, oil ramps and then it crashes. If oil crashes here, dude, get out of the way because it's going down. All right. It is fully my anticipation that the Federal Reserve will cut interest rates before the summer. I'm anticipating that if they don't do it at the June meeting, it will be a special meeting right after that, or it will be the next Federal Reserve meeting, which, by the way, if they don't cut before the summer, you have to remember that the summer is going to be like a 2-month hiatus for the Fed before the next meeting, which means it gets deferred until September. So if they don't cut in July, the next meeting is September. All right. So between the next two meetings, I fully anticipate there's going to be a Federal Reserve rate cut. At the very least, there will be a complete wind down of quantitative tightening because of what I talked about earlier. What else are we looking at today? All right. Lumber continues to be weak. So again, not good. Housing sector, demand down. Lumber's getting crushed. Okay. Gold and silver are just kind of flatlining. They were down a bit yesterday, but again, I really think that gold and silver had a big run. There's a lot of profit taking. I think what's going to become very much apparent to people is the Fed is actually easing, which is not a good thing. it signals that there's weakness, which means gold and silver will start to rise again in the near future. Right now, you're getting a discount to buy gold and silver. Just a thought. All right. Something else to note is the gold to silver ratio. Notice how there's not really a lot of movement today, but there is movement in the ratio because silver's up slightly and gold's just flat, slightly down. All right. That ratio has improved a little bit over the last 24 to 48 hours, something to continue to keep an eye on. Okay. I think silver will outperform gold over the next 5 years. Just a hunch. Palladium continues to get shellacked. Palladium is down big. Okay, talk about like commodities. Uranium is down. No, sorry. Uranium spot price is up today. Again, I don't know if this is necessarily going to be a sustained move higher, but the URA ETF has been strong as of late and continues to be. So something to keep watching. Uranium is continuing to be a thing, whether people are paying attention to it or not. Nuclear energy is probably a more viable future than at least green energy is in the near term, but we'll see how that plays out in regulatory land. All right. Fixed income, we talked about enough today, so I'm not really going to talk about it too much, but just note that the high yield bond ETF is back within that consolidation range, and it's seen some support here after the Fed decision. So you'll see what's happening there. Currencies, actually, I haven't talked about this enough, but what's happening with the yen is just complete chaos. Okay. You're seeing some of these like really chaotic moves back and forth happen in the market, currency markets, some of the foreign debt markets. You're seeing some really erratic movement here. Typically, that doesn't mean good things on the horizon. The Bank of Japan had to intervene. It was getting away from them. The traders were pushing the yen down, which basically means that this pairing goes higher. Look at that spike. For a nation's currency, this kind of movement is not good. How do you plan your spending patterns as an individual? How do you plan your savings and your retirement? How do you plan as a business if your currency is just whipsawing all over the place like this? I mean, in very short order, it's gone from 141 and it topped out at like 160. Okay. You're talking like 9-10% of the overall currency changed value in like a year. Actually, less than a year. It's been since when did it hit this low? December. I mean, you're talking less than half a year. You're talking about a 10% fluctuation in your currency value. How do you live in an environment like that, right? It's not going to be good. All right. Bitcoin is up today. It's got a little bit of support. Yesterday, when I was looking at it and I was weak, I said, you know what? Would not surprise me if it gravitates back towards the 60,000 line. We'll have to see whether or not the casino stays strong, because typically that means risk assets are being purchased. That means that Bitcoin is a risk asset. It will be purchased and it will move higher with the casino. All right. It is steadily reapproaching 60,000. So we'll have to see what happens. Does it get beat back from that level, or is it able to pop back above it and into this consolidation range? I mean, I anticipate that Bitcoin's going to continue to be weak, but again, in the near term, it could have some strength in sympathy with risk assets. But ultimately, I'm looking for this thing to pull back to this, 54,000, 53,000 range before we finally get the Federal Reserve truthfully, not truthfully, the Federal Reserve, what's the word I'm looking for? Like, without a doubt, riding in on the white horse or riding in on the Ben Bernanke issued helicopter and dropping dollars from the sky. I think we have to revisit 53 or 54,000 in Bitcoin before that happens. And you finally see Bitcoin make that move much higher. Most of the crypto space is up. Bitcoin's actually up more than the rest of the crypto space today, so that's something of note. It's not up like a huge amount, but still, it's got some support here as opposed to getting just annihilated like it was yesterday and the night, not last night, the night before in the overnight trade. Some of the names in the crypto space have caught a little bit of a bid here. Nothing really like earth shattering or tectonic moving in terms of that price action. A lot of this is just kind of, there was weakness and now there's a little bit of a bounce. Doesn't necessarily signal any kind of like direction shift. I think what you could see is Bitcoin participate with the casino and the rest of the crypto marketplace get left behind. Meaning, because you now have this ETF influence in the pricing of Bitcoin, you could see Bitcoin participate with some level of, the stock indexes moving higher, and again on less strength because of the hopium that will eventually get crushed. But I think you could see Bitcoin participate much more significantly or much more closely to the casino movement, and the rest of the crypto space remain weak, where the crypto space just kind of gravitates up a little bit, but it doesn't really see a ton of inflows. All right. Something to keep an eye on is that relative movement of Bitcoin versus the rest of the crypto space. Everyone looked at, halving and, halving happened. Now we might see a little bit of a weakness afterward from, whatever, miners selling off and having to retool and then, buying more miners. And that's going to be, ultimately a tailwind for the final move here with Bitcoin. I don't know whether or not that's actually going to be the catalyst. I actually much more so think it's going to be the economic environment and the Federal Reserve's, actions to try and influence the market. But I really think that Bitcoin and halving is inconsequential here. I think what's in the driver's seat is general market dynamics, and not just in the crypto space, but in the marketplace in general. And then I also think that there's an element here of, this ETF intrusion into Bitcoin. I think that it is married right now with tech stocks and the NASDAQ. Again, do an overlay. I've done it multiple times. It continues to play out. All right. Something that will further prove that thesis will be if Bitcoin moves with the NASDAQ here, whether it be up or down. Okay. I think a lot of the other micro cap and small cap cryptos are going to be left behind. And the thesis that, Bitcoin moves and then the other things rally, that's in an up market. We could be topping out here, which means I think if we hit that top in Bitcoin, I don't think it's going to be followed by some kind of magnanimous move in small and micro cap cryptos like everyone's expected in the 10x crowd, right? Or the 100x crowd. I don't foresee that happening. I could be completely wrong. I might be left in the dust, but again, I'm very conservative as far as these things go. So just keep that in mind. All right, that's all I really got today. I was very long-winded. I appreciate you gutting it out with me. All right. A reminder, this is the first day I'm live on YouTube. So either go into YouTube and search out the Anarchist Investor, or use the link in the description below to give me a subscribe and a follow and a like. Help me with that algorithm. Obviously, I speak my mind. YouTube algo is not going to be kind to me, so I need that engagement to get me going. And also the Rumble feed, as well as any of the other feeds that you're watching or listening on. Please do me a favor and give me an upvote, a follow, or a subscribe. It will go a long way towards helping me continue to do this, and also towards getting this content in front of people that could be helped by it and ultimately want to grow their wealth over time, regardless of what the economic environment looks like headed here into the future. So with that, I appreciate all of you. Thank you so much for your attention and your energy as usual. We got one more day left in the week. I will be back here tomorrow live at noon. And so I hope to see you there. With that, peace.
Stuck in a system that just ain't right. Gonna tear it down, gonna start a fight. Anarchy and numbers is my game. I'm the investor with no shame. Greed and corruption, that's the name of the game they play. It's all a shame. I won't play by their rules, I won't comply. Anarchy's the way. It's time to fly. I'll burn down the walls and break the chains, shatter the illusion, expose their gains. The stock market's a stage. I'll steal the show with my rebellious spirit. Watch me grow. Burn down the walls and break the chains, shatter the illusions, expose their gains. The stock market's a stage. I'll steal the show with my rebellious spirit. Watch me